and welcome to Dialogue. On Tuesday, the IMF announced a steep downgrade to 3.6% to its global growth forecast for this year as a result of the war in Ukraine and accelerated inflation in many countries, as well as other factors. With no end in sight for the war, what could be done to improve the global economic outlook? How can inflation be managed? And how can we better respond to global shocks and uncertainty? To discuss these issues and more, I'm very pleased to be joined today by Steve Barnett, Senior Resident Representative in China of the International Monetary Fund. That's our topic. I'm Xu Qinduo. Hello, welcome to the show, Stephen.
Thank you.
I understand that you have been attending the annual meeting held by the IMF and the World Bank recently. So what are your takeaways?
Yeah, well, first off, thank you so much for having me back on the show. It's really a pleasure to be here today. I wish I was there in person, but I'm here in Washington, D.C. You know, my key takeaway is that multilateral cooperation remains essential. You know, the global economy is facing considerable challenges. Basically, it's been hit by crisis on top of a crisis. You know, before the pandemic, we faced challenges like tackling climate change, reinvigorating trade, and adapting to technological change. Then the pandemic hit, causing the largest global recession since the Great Depression nearly 100 years ago. And you know, just as the impact of the pandemic was starting to ease, we had the war in Ukraine, causing higher food and energy prices, lower growth, and more economic uncertainty. So my main takeaway from the IMF spring meetings is that addressing these problems and securing a global recovery will require the global community to work together.
Well, the IMF, has downgraded the growth forecast for this year to 3.6%, a very steep drop if we compared that to 6.1% last year. So what are the major concerns behind such a cut?
That's correct. It is a steep drop in growth. You know, it's also a big drop in this year's growth forecasts. So, you know, just back in January, we were forecasting global growth to be 4.4%. So our current forecast is a reduction of 0.8 percentage points in just a few months. Now, we also marked down growth for next year to 3.6%, which is 0.2 percentage points lower. You know, these downgrades are widespread. We marked down growth this year for more than 140 economies, accounting for over 85% of global GDP. You know, so for analytical purposes, we like to split the world into two groups. One is the emerging market and developing economies. You know, for this group, we marked down growth by 1 percentage point. And for the group of advanced economies, we marked down by a little bit less, 0.6 percentage points. This also highlights how the pandemic, the repercussions of the war in Ukraine are having a bigger impact on emerging market and developing economies than they are on advanced economies. You know, you also asked me what can be done. I think first is to end the war in Ukraine. You know, we know that conflict is bad for development and that this conflict is having reverberations felt globally. Second, we need to confront COVID. To fight it, we need a variety of tools, including vaccines, testing, antiviral treatments, and importantly, these need to be deployed everywhere. You know, this pandemic provides really a great illustration of how health security is so important for economic security. You know, the last issue, as you mentioned in your introduction, is to tackle inflation.
Mm-hmm. Well, Stephen, I was speaking to a couple of economists at the Boer Forum, then some suggest like a 3.6% of economic growth globally. It's not really a bad number. They pointed to the pre-pandemic period. They say, the economic growth on average is about about 3%. Last couple of years, because of the different special situation, I would say, you register like a 6.1% globally. That's because the previous business is very low. What do you make of that?
No, it's a good observation. And it is true that global growth over, let's say, the last 35, 40 years has averaged a little bit over 3%. So the 3.6 doesn't sound that out of line. But we have to look back to 2020. Remember, growth that year was -3. So if we look at where we were at the end of last year, global the level of global output was still well below the pre-pandemic trend. So basically, we haven't caught up and made up for the pandemic losses. So I think in that sense, you could say there's quite a bit of scarring. And to add to that point, even if we look out to 2025, 2026, we still see that there will be scarring. By that time, advanced economies have roughly caught up to the pre-pandemic trend levels. But in emerging market and developing economies, and in particular in Asia, they're still well below the pre-pandemic trends, just showing that there's a lasting impact in showing that you would expect growth to be higher to close the gap, basically.
Mm-hmm. Well, you mentioned the inflation as one of the factors affecting the global economic performance. Indeed, it is a problem. If you take a look at the developed world, for example, inflation in the US, 8.5%, in the EU, about like 7.5%, the UK, 7%, all decades high. China has been basically able to curb its inflation rate at like 1.5%. I wonder, what do you make of the difference in inflation rates among the major economies?
Yeah, I mean, this is a good point. Inflation has risen, and we really expect inflation to remain elevated and for longer. And although inflation is fairly broad-based, as you know, we do see differences across country groups. For advanced economies, we expect inflation for the whole group to be 5.7% this year and 8.7% this year, and 6.5% next year. Both of those have been upgraded relative to January. For emerging market and developing economies, we expect even higher inflation, and our revision was even higher. As you highlighted, China is a bit different. In China, we project both headline and core inflation to remain below 3% in the near term. But I'd add this really, an important point is to look at the reasons for inflation. Most recently, we see that the war in Ukraine is driving up commodity prices, in particular for energy and for food. If we look, Russia and Ukraine together produce over 1/4 of the world wheat export. And Russia and Belarus accounted for about 40% of potash exports. Potash is a type of fertilizer. And these rising food and energy prices are a particular concern for low-income households in low-income countries. Why is that? Basically, we know that poorer households spend a larger share of their income on food, and in particular food and also energy. So the high inflation is having a heavy burden on them, and it's actually threatening food insecurity in some places.
Mm-hmm. Well, Stephen, if the inflation continues to climb globally, tell us what the outcome would be.
Yeah. So, as I mentioned in my opening remarks, tackling inflation is really a priority. And I think it's to tackle inflation, we have to understand the causes. So at the moment, we see that food and energy prices are contributing to the inflation. And this is relevant because usually you would think that central banks would not respond to a supply shock like this. Now, central banks tend to focus on core inflation, that is inflation taking out food and energy costs. The reason they do that is because core inflation is, let's say, subject more to the control of monetary policy. But here, if we look at core prices, we see they're also rising. And in particular, the core prices of goods are rising faster than for services. And this reflects something we've seen in the pandemic. Basically, there's been a rotation of demand where people are consuming less services and more goods, and maybe to be less fancy. People are buying television sets, they're not taking vacations. So we see a pickup in demand for goods, a lull in demand for services. It was tough for the supply to keep up with this change in demand. So we've seen goods inflation, but it begs the question, what should central banks do? And I think one thing, they need to continue to clearly articulate the policy outlook and adjust the monetary policy stance in a data-dependent way. And if I can, one last point here is that for inflation, expectations are really important. They're important because if workers expect inflation, then they're going to demand higher wages. When they get higher wages, they're going to have more money to spend. When they have more money to spend, they're going to then create inflation. So inflation expectations can kind of create the self-fulfilling cycle. So central bankers look a lot at expectations. And what we've seen so far is that in the near term, there has been a pickup in inflation expectations, but they remain kind of well anchored in the medium term. And thus, in our recent Global Financial Stability Report, kind of the main conclusion was that central banks should act decisively to prevent inflation pressure from becoming entrenched and to avoid what they called an unmooring of inflation expectations.
Interesting. So basically, you pointed out the management of the expectation of the inflation is very important. So does that mean, suggestion means like the central banks around the world should take firm actions to raise interest rates, for example?
I think it was almost the reverse. They should keep a close eye on inflation expectations as a key indicator. So right now, to give a concrete example, if you look at the US, for example, whether we look at surveys of people's expectations of inflation, or whether we look at the market price of inflation, you can actually, from financial markets derive expected inflation rate. What we see is it has risen a little bit, or not a little bit, has risen in the near term, but it's still well anchored in the medium term. That suggests that people in markets expect inflation to come back down so that the US then can continue along the course of monetary policy that it has.
I guess, countries, the situation vary from one country to another. In the developed world, in the United States, probably different from the European countries, which are more affected by the ongoing war. And then if you look at the developing world, you have these emerging economies, China, India, probably they are a bit different from other developing countries too. So I guess, the tools they have to deal with inflation also vary a little bit.
Definitely true. When we've looked in the past at basically how monetary policy in advanced economies spills over into emerging market and developing economies. And we say monetary policy in advanced economies, but really it's monetary policy in the US that has the strongest impact on other countries. And one of the key findings of our research in this area was that provided that the monetary policy in advanced economies was well communicated, basically if it follows the principle of no surprises, that emerging market and developing economies were able to weather the normalization of monetary policy okay. And it also matters what the policy framework is in those countries itself. So we saw that emerging market and developing economies that had stronger macro policy frameworks, meaning their budget positions were better, their monetary policy frameworks are better, they also tended to do much better when monetary policy in advanced economies normalized.
Prospect of green growth in China.
We can extend its coverage beyond the power sector, so we need to find ways to get the private sector involved.
Restore the global supply chains.
Global value chains actually showed a lot of resilience. Multilateral cooperation really remains essential.
Let's take a look at the performance of the Chinese economy. Its first quarter GDP growth is 4.8% year on year. It's above the expectation. It's also better than the last quarter of last year. That's basically 4%. But also it's lower than the targeted yearly growth, 5.5%. Some think restrictions to deal with the COVID outbreaks in the country could bring future risk to the growth. How do you see the economic growth of China?
Yeah, I think you're right. The Q1 outturn at 4.8%. Really was a bit above the consensus. I think if I recall, the consensus was a little bit below 4.5%. But if we look at that, what we saw was fairly strong activity in January, February. If we look at things like value added of industry, retail sales, fixed asset investment, all pretty strong in the first 2 months. But then once the COVID outbreak expanded and we started to see lockdowns, that the March data showed much more weakness. In particular, retail sales was actually negative year on year in March. So what we see is as a result of the COVID outbreak, a loss of momentum. So we at the fund, we downgraded our forecast to China. We're now expecting growth this year to be 4.4%. But I should add that builds in already this weakening of domestic growth momentum that we've seen. It builds in the effects of the war in Ukraine, as well as the ongoing weakness in the real estate sector.
So, of course, the official target remains like a 5.5%, and also the Chinese central government obviously is aware of increasing uncertainty and challenges, both domestically and externally. So do you think there are enough tools for the Chinese central government probably to exercise in order to not exactly 5.5%, probably to achieve the maximum, at best, let's say?
Right. If we look, the target of around 5.5% growth, does appear ambitious, especially in light of the recent COVID outbreak. But I would add, even before the outbreak, and the government work report itself said in reference to the target that achieving this goal will require arduous efforts. But you mentioned the policy space. In fact, I would say if I look at the macro management right now, I see kind of two broad areas of challenges. First is the near term, and this is exactly what you're referring to. How can China support the economy? And I think the short answer, China has the policy space. I would say fiscal policy in particular can provide an important boost to growth this year, especially by focusing on policies to lift consumption and promote greener growth. I think on consumption, one example would be fiscal policy measures to strengthen the social protection system. This would provide a really nice lift to households and a nice boost to consumption. I think the second area is it's really important not to lose sight of the medium term. And here, I think there are three key challenges. The first is to continue to press ahead with structural reforms. These will unleash market forces that can fuel sustainable growth going forward. The second actually builds on my last point about consumption. If we look at in China, China's really had remarkable growth in household consumption over the last few decades. However, it turns out that consumption actually in general hasn't grown as fast as GDP. And what we see is that China's consumption share of GDP is very low by international standards. So over the medium term, a key challenge is to boost consumption, and that actually would be a good thing. That would mean that living standards are actually growing faster than GDP. And the last point is to grow in a way that addresses climate change.
Mm-hmm. What are the usual practices, for government to, in particular at a certain economic development stage, to boost domestic consumption, to encourage people to spend, and of course you want to probably increase the salary, the income, so they have to spend in the first place.
Yeah.
But what on the government side they can do to encourage people domestic consumption, for example?
Right. I think you actually raised the two key points. One is to reduce savings. And the second one is to increase household share of income. We need action on both of those if we want to see the consumption in China growing faster than GDP. You can think of ways to reduce savings. One key way is what I mentioned earlier, is to strengthen the social protection system. You can think that households in China may save for healthcare expenses. They may save in particular for the risk of a catastrophic health event for which there's not good public insurance. As a result of that, households in essence save too much. So with a stronger social safety net and a stronger social protection system, households would actually be able to save less. Tax policy reforms can also contribute. The reduction in payroll taxes, for example, would be one way to provide support for households. We saw that during the pandemic in 2020. There was a temporary reduction in the Social Security contributions. But overall, lifting household share of income is actually a bit trickier. But I think one key way to do that is over time, as the economy moves kind of away from manufacturing and more towards services, we tend to see that services are more labor intensive. So an economy that has more services in it tends to also have a higher share of income to households, and the higher share of income households have, the higher share of consumption.
Good point, Stephen, over there. Do you think there's also like a cultural or traditional factor here? For the older generation, there's a strong tradition of saving. People simply become, it becomes a habit. But for younger generation Chinese, I'm not sure whether you have noticed that people are more open to spending, probably saving much less than their parents' generation.
Yeah, it's a great question, and I'm chuckling. I've had the pleasure to work on China for many, many years. We looked at that exact question, I think it must have been about 10 years ago. And at least at that time, our empirical finding was that you could explain the savings behavior in China, the consumption behavior, by a standard macro model. So we didn't really find a role for, let's call these cultural arguments. But that was 10 years ago, so maybe things have changed. You certainly do hear this argument a lot, that the young people save less. I just haven't seen the data. It's a good research question for us, actually.
Yes. Well, let's move on to another very interesting point here. China has been expanding its green investment. The China Development Bank, for example, issued about 17 billion US dollars in the first 3 months of this year to promote clean energy development. How do you view the prospect of green growth in China?
Really an important topic for the world and an important topic for the fund. China is going to play an important role in the global fight against climate change. We all know China's headline goals are to reach peak carbon emissions before 2030 and to become carbon neutral before 2060. So I think that, the focus is how to do this. And we've seen already the implementation of some climate policies. Last year, we saw the rollout of the national emissions trading system for the power sector. This is a good start, but we think the system can be made more effective. We can extend its coverage beyond the power sector. We can shift to have a cap on total emissions. We also see space for market reforms in the power sector. These effectively can make carbon pricing a better tool by allowing, let's say, prices of energy to adjust more in line with supply and demand. We could think of incentives for the private sector to invest more in renewable energy, such as solar energy and wind energy. Other policies include, for example, extending the coal tax. And I think last but not least, I'm going to pivot back to our last point on consumption. That actually switching the growth model away from one kind of heavily reliant on investment to one that is much more consumption-led is actually really good for the climate. Services, which in consumption of services tends to be much friendlier to the environment, uses much less energy, is much less polluting. So that shift of the economy to a more consumer-led growth model that has much more services in it actually can make a significant contribution to achieving China's climate goals as well.
What about the progress? What do you make of China's progress so far?
I think that, at a personal level, I actually lived in China. We lived in Beijing in 2003 and 2006. In living there now, you can see the difference in the air, literally see the difference in the air quality. So we clearly see, I clearly see, signs of progress. But I think really it's so important going forward to meet those carbon goals of carbon peaking before 2030 and carbon neutrality by 2060. So China can really press ahead with all of the reforms that we've talked about. The emissions trading system to get carbon pricing right. China's done a lot on green investment and green finance in particular, and it should continue along that path to make green finance as attractive as possible. In particular, that could encourage investment into solar, wind, and other types of renewable energy. And I'll come back to my point on consumption because I think it's underappreciated. It's a macroeconomic policy, pivoting the economy towards consumption that also can make a significant contribution to achieving China's climate goals.
Well, let's take a look at the impact, obviously, of this pandemic 2 years long. It's continuing a little bit, and the war, as more and more countries, ease restrictions and open up. Will that help restore the global supply chains, or has the global supply chain already been, irreparably changed, as some experts claim?
Yeah, this is, a great question. And my colleagues in the research department actually took a close look at this question because we've been getting it a lot. And I think the key finding, at least to me, was that global value chains actually showed a lot of resilience and adaptability during the pandemic. When the pandemic hit, we expected trade to collapse. And in many respects, it did. But I think surprisingly, it also bounced back quickly. This is especially true for trade in goods. So it could be that trade and services may remain sluggish, really driven by the collapse in travel. But as countries open up and travel resumes, this could actually also help boost trade and services. I think one lingering question is whether there's going to be a permanent change in demand. Will travel ever return to the pre-pandemic patterns? For example, has teleworking or has virtual meetings like this, kind of video conferencing, replaced permanently some types of business travel? But as for goods, we did see the trade in goods, which rely heavily on global value chains, was actually a bit more volatile in the pandemic as supply chains were disrupted. But overall, trade was fairly resilient in the pandemic. falling sharply initially and then recovering rapidly in line with economic activity.
Well, recently, IMF has done research which suggests countries diversify their supply chains because having more source countries and inputs can significantly reduce the economic drag from supply disruptions. Would you please elaborate on that a little bit more?
Yeah, that was actually the same chapter I was just referring to that found that global value chains were resilient during the crisis. That chapter also explored ways to make them being global value chains, more resilient. And as you noted, one way was to diversify away from domestic sourcing of inputs. And another way was to have greater substitutability of an input. That is making it easier to switch supplies, if you will, between countries. And why is that? Basically, having more options for buying input goods means that there would be less disruption when a single supplier or country is hit by a shock. This is kind of a classic gains from diversification argument. The chances of multiple suppliers being hit or multiple countries being hit by a shock at the same time is much lower. So that makes sense to diversify. And this also, the same logic applies to domestic input sourcing, suggesting that diversification gains from sourcing more inputs from abroad rather than reshoring, actually getting more from abroad. One other thing they did is, we know that by and large, supply chains are based on firm level decisions. But there are steps the government can take to strengthen global supply chains and global value chains. And I'll flag two. One is enhancing infrastructure. Upgrading and modernizing port infrastructure on key routes can help reduce these global choke points. And the second is to reduce trade costs. This includes reducing non-tariff barriers, as well as reducing trade policy uncertainty.
Well, a related question, Stephen, there are people discussing or wondering whether the globalization has been ended, because of the pandemic, because of the war. There are also ideological differences, geopolitical tensions. Some countries are trying to build a so-called value-based supply chain, and more or less the world is becoming a little bit more divided. Are you worried about that?
Yeah, I should say, our research on supply chains suggests that this reshoring, is what we call it, that you talked about, is not the solution. So moving production of inputs onshore instead of importing is not the way to go. What we've seen again with the war in Ukraine, aside from it causing tragic humanitarian crisis in Eastern Europe, is that it's also added to this series of supply shocks that have hit the global economy and is fueling some of that sentiment that you talked about. It's leading to rising food and energy prices, which we know have a strong impact. We also know that the impact, because of these supply chain linkages, goes beyond energy and agriculture, and that we see how disruptions in one country can quickly cascade globally, just illustrating how interconnected the world is. But I think, therefore, a big challenge and a key challenge for the world is to exactly avoid a more permanent fragmentation of the world economy into these geopolitical blocks. Separate blocks could have distinct technology standards, distinct cross-border payment systems, separate reserve currencies. Such a major shift would be really costly. The adjustments costs would be huge, and we would lose a lot in efficiency, as well as we have to move supply chains and switch production networks. So, again, as I mentioned in the opening, to me, a key message of our spring meetings is to avoid this and just emphasize that multilateral cooperation really remains essential.
Thank you, Stephen. With that, we come to the end of today's show. Many thanks again to Stephen Barnett, Senior Resident Representative in China of the IMF. You can also watch us on the CGTN app on YouTube. Thank you for being with us. I'm Qin Zhuo. See you next time.